This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Alright, finally, you can see what's coming. This is a lovely bit of fun. I've put other financial ratios. Now, again, listen carefully for 2 minutes. You should already be aware from other exams and things, there are all sorts of financial ratios we could look at. I've just mentioned one or two. The gearing ratio, for instance, is a financial ratio, all right? In this exam, very, very often, he gives you a set of accounts or extracts from them. You'll see here, I've given you a balance sheet, income statement. He asks you for a few financial ratios, and not always, but usually a comment on them. Now, he never asks loads and loads and loads, but in virtually every exam, as part of a question, only part, he asks you, and he specifies, he asks you to calculate 3, perhaps 4 financial ratios. All right? And it's virtually every exam. And shortly, I will actually give you an old exam question, show you exactly what I mean. But he's always doing it. He's only ever asking for 3 or 4. And he'll say, you know, calculate what is the gearing ratio, what is this ratio, what is that ratio. He specifies. But he has got a lot he could choose from. And if you turn over, there aren't that many. But I've listed on the next 2 pages just about, I think, all the ratios he's ever asked. He'll never ask for all of these. I say again, it'll be 3 or 4. It could be any 3 or 4. Most of them I think you should have heard of before, but it won't take us a minute to run through. And of course, part of the marks is just pure learning. If I ask you what's interest cover, if you've learnt it, that is a joke mark. Clearly, he will expect a bit of comment, you know, as to what it means. You know, has it got better, has it got worse, sort of thing. Okay? Now, I want to be efficient here. It's not fair on you just to go on and on unnecessarily. What I want to do, I'm afraid it is backwards and forwards and you'll have to check me. I've given you income statements, balance sheets for 2 years. And clearly in the exam, if he does that, he would expect you to do the ratios for each of 2 years and then comment. We're not going to waste time here, please, doing it for each of... If you can do it for 1 year, you can do it for the other year. You would agree? Everybody? And so let's see how quick we can be. I want to run through. I'm only going to do them for 2002. All right? But in your own interests, even if you find all these perfectly obvious, have a look back later. You do 2001 next week or something, you know, and check you can remember them. Okay? The answer's at the back. So let's just run through each. It's very much, of course, just learning what is it. And then, he'll never expect much, but being able to make a sensible comment as to whether it had gone higher or lower. Okay? So, let's see how quick we can be. And please help, because it keeps meaning, turning backwards and forwards, which is annoying. Check I'm not missing a figure. First of all, interest cover. It's defined as being the profit before interest and tax divided by the interest. Well, for each, as I say, to make sure there's no confusion what I mean, just for 2002, the profit before interest and tax, have we all found it, is 52,000? The interest is 6,000 The interest cover, we generally just leave as a number. 52 divided by 6. Will you check me? I get 8.67. All right? Now come on, help me please. I want to be efficient. If it's obvious, great, we can move on. If it isn't, shout. Everybody happy? Well, I'm not going to write down a chat, and we're not going to do last year's. We're not. Do it late. It's actually useful to do it next week. You know, and just check you can remember them. However, what is the relevance of that? The relevance, I'm not going to write down, but the lower that number gets, if that number, for instance, came to 1.2 or something, that would mean we could only just afford to pay the interest. The lower it gets, the more scary it gets. Because, you know, we've got to have at least 6,000 to pay the interest, otherwise we risk collapsing. You would agree? So here, there's absolutely no danger. I mean, we can afford the profit to drop hugely before we get scared. But if you had got an answer of something like 1.2, I think you take my point, I'd be rather worried. It only needs profits to drop by a small amount. And of course, if you can't pay your interest, then we could end up collapsing the company. You agree? Fine. Here, though, we look very healthy. There's no apparent problem. The next one, the interest yield. Well, we had this earlier. The interest yield always relates to our debt finance. It's the interest as a percent of the market value. Well, what's the interest rate on our debt? If you look at the balance sheet, the coupon rate is 6%. Have you all found it? So you're paying $6 a year on nominal. At the top of page 78, I've given you some market values. The market value of the debentures, 2002, is 110. And so, investors are getting $6 a year coupon on 110 market value. The interest yield is that right? 5.45%? Come on, please. Yeah. I'm not going to discuss it anymore. I mentioned it before. You know, that's the rate of interest effectively new investors are getting. Carry on down. The shareholder ratios. Well, no excuse here, I hope. Oh, except for one little thing. Ooh. Dividend per share. The dividend per share stands to reason. It's the total dividend divided by the number of shares. The only thing, and I think it's reasonably obvious here, is if you look at our balance sheet, we've got ordinary shares and we've got preference shares. Yep. Well, when we talk about dividend per share, always you're referring to the ordinary shares. Because that's the one that stands to change each year. The preference dividend, of course, remains fixed. All right? And so what is it here? The total dividend, 2002, is 20,000. Have you found it? Incidentally, I better say, I know that dividends shouldn't actually appear on the income statement. True? Hello? Financial accounts. Well, fine, we're not financial accountants, I don't care. Your examiner very often shows dividends there. All right, strictly he's wrong, but it's fairly irrelevant. I think you'd agree, yeah? However, the total dividend for ordinary shareholders is 20,000. How many ordinary shares are there? Again, be careful. It's obvious, but even so, the share capital, they're 10. Oh, can you change that little P to a C? I do apologise. Share capital, it should say 10-cent shares. Peter? So how many shares are there? The balance sheet has $60,000. If they're 10-cent shares, we all agree, I hope, 600,000? Which is what? 20 over 600. Am I right, please? Just over 3 cents per share? Everybody? Incidentally, although I can't believe he'd ever asked this, preference shares, I've kept saying they're always paid a fixed dividend. The usual way it's expressed is the way here. If you look at the balance sheet, it says 7% preference shares. Yeah? The nominal value, $1. It means that the fixed dividend is 7% of nominal value. So the preference shares, the fixed dividend would be 7 cents a share. Okay? Bless you. Ludzu. As far as discussion's concerned, I think fairly obvious, but just one thing. Obviously shareholders are interested in the dividend. If you're comparing year by year, I think fairly obviously, if dividend per share's gone up, shareholders will be pleased. If dividend per share's gone down, they'll be less pleased. You would agree? But do remember that if dividend per share has gone down, it could be because there's less profit, and obviously that's bad. It could be simply the company's retaining more, which might give problems for the reasons I said before, but isn't directly bad. You with me? So use a bit of sense. If dividend per share's gone down, by all means say it's worrying, but have a look and see, is it because they've less profit or is it because they're retaining more? Right? However, back to where we were. Dividend cover is, in a sense, how much they're retaining. Dividend cover is the earnings available for dividend divided by the total dividend. But be very careful of one thing. Dividend cover, again, you only look at the ordinary shares. Tell me, what's the maximum ordinary dividend this company could pay, 2002? What are the earnings available to pay the ordinary dividend? 100 and what? I want to know how much earnings, what profits are available to pay ordinary dividend. What's the maximum ordinary dividend they could pay out of this year's profit?
64?
Almost. The net profit after tax is 34.
-2.
Yes. Surely this year, I know what you mean, Vita, and I'm sorry, but we're doing it sort of just on this year, yeah? This year, There's 34,000 profit at the end of the day after tax, agreed? However, that couldn't all be paid as ordinary dividend. 2/8 of it is preference. So the maximum dividend they could pay out of this year's profits is the difference of what? 31,200, I think. How much dividend are they actually paying? 20,000. And therefore, the dividend cover, bless you, is it 1.56 times? Tell me, what information is that giving us? You know, if next year the dividend cover was 3 times, what would it mean? Can anyone tell me? Think about it. Out of this year's profit, they could have paid 31,200. Yeah? They're only paying 20, 1.56. Yeah, they may have only been paying 10. If they were only paying 10, the dividend cover would be 3.12 or something. What does it mean if the dividend cover is higher? They're retaining more. Think about this. Surely, the higher the dividend cover, just 2 things. Higher dividend cover means they're retaining more, number 1. Would you all agree there? Would you all agree, though, I mentioned it earlier, why does a company retain? They don't just keep the money. Presumably they're retaining to expand the company. And something that's going to be very important next time, if they are retaining more, you'll be expecting expansion and more growth. I say expecting. Things don't work as planned always, but the more a company retains, the more you'll be expecting them to grow in the future. Would you agree with me? All right? You better add in, please. He has asked this effectively the other way round. Could you add in, it fits with this, squeeze in somewhere, something called the payout ratio. Which is exactly the same thing, but stated the other way round. Payout ratio is the dividend divided by the earnings available for dividend. And again, we only look at ordinary shares. So it's exactly the same, but the other way round. Again, 2002, they're paying 20,000 ordinary dividend. The earnings available, 34,000 minus 2,800. So if he asked you the payout ratio, it would be, I think it's 0.64. So I hope I'm not confusing. There are 2 ways you can look at the same thing. All right? And the payout ratio, tell me, if the payout ratio is lower, if it was only 0.2, would you be expecting the company to be expanding more or less if the payout ratio is lower? Yeah. Surely if the payout ratio is lower, you're paying less as dividend, you're retaining more. And the more a company retains, the more you'd be expecting that it would grow. All right? So effectively the same. No problem. Next one. Where are we? Which one am I up to? Dividend yield. The dividend yield, it's a same idea, in fact, as interest yield. We only look at ordinary shares. But it's the dividend per share as a percentage of the market value per share. All right? Obviously, investors are interested in dividend, but of course, the more you're paying for a share, the more dividend you'll be wanting, sort of thing. So check the figures. The dividend per share, can somebody look back? We'd worked it out earlier. It was 0.0333 or something. Oh, nobody's helping. 0.0333. The market value per share at the top of page. Where's my? Oh, top page 74. The market value of an ordinary share is 83 cents a share. Is it? Oh, there's a bit of rounding here, but I get something like 4.02%. 4.02? Oh. 0.033333 divided by 0.83 equals 0.0402, which is 4.02%. Am I going daft here? Oh, so I'm not. Oh, I'm going to argue about a bit of rounding. I use 333. If you've used 0.03, if you asked it in the exam, hopefully it'd be nice numbers anyway. All right. I'm not going to argue. It's about 4%. So use a weight, please. This isn't very likely, actually, but even so, think about this. If you were thinking of buying shares on the stock exchange, you might be interested in this. I think you'd agree. You know, clearly the more dividend you get, the better. But surely, if I was buying on the stock exchange, you'd want to compare the dividend you'll get with the amount you're investing. Do you agree? And so if I'm going to pay 83 cents a share, all right, I'll be getting a 4% return. Well, in one sense, obviously, the higher the percentage, the better. I think you'd agree. But can somebody tell me why, in fact, it doesn't actually mean very much? Yeah. Yeah, I mean, there's two problems that go together. Ever. They go together, but the point is, it's based on current dividend. And all right, based on current dividend, you pay 83 and you're getting 4%. The reason it's a bit misleading is surely, normally, you're hoping that dividends will increase in the future, number one. So you pay 83 and you'll be hoping to get more than 3 cents a share later. And in fact, the two go together. But you'd perhaps be hoping as well that the share price will grow. And obviously if the share price is growing, then again, you're effectively getting a bigger return. True? And so although they do print that in the papers often, it's not actually terribly useful You know, if you think this dividend's going to shoot up and the share price shoot up, you're actually getting a lot more. If you think the dividend will never go up and share price never change, all right, you're only getting 4, but I think I've made the point, yeah? So fair enough, that is the better, but it is a rather dangerous number. Nearly there. The next one, in fact, cross off. Return on equity is never asked and doesn't actually mean anything. Cross that out. I'm not interested. What I am interested, though, is the last two. First of all, earnings per share. I don't know how many of you have done F7. Has anybody done F7? Yeah? All right, F7, this can get quite messy, but never in F9, never. The earnings per share is the earnings available for ordinary shareholders divided by the number of shares. Ordinary shares. It's only ordinary shares we're worried about. Preference shares, everything's fixed. Tell me, I think we had the figure before. But how much, 2002, how much is available for ordinary shareholders? Yeah. The profits after tax are 34,000. 2,800 has to go to preference. And so for ordinary shareholders, there's what, 31,200. Well, there are the earnings. Divide by the number of ordinary shares. We already had it, I'm right, aren't I? 600,000? And so you'd better check me. Is it 5.2 cents? Is that correct? Two things there. I did say, for the two of you who've done F7, at F7 it can get very messy because of issuing shares during the year and fully diluted and things. F9 irrelevant. There's never any of that problem. It's always that simple. Alright? There's no tricks. So I don't really think there's any excuse there. Secondly, I said earlier, shareholders are going to be interested in the dividend. Essentially, higher dividend, they're happy, lower dividend, they're not. But I did say you've got to be careful. Lower dividend could be because the company's doing worse. It could be simply they've retained more. Agreed? And so although nothing's perfect, earnings per share is actually far more important. If earnings per share is going up, then the company certainly is doing better, sort of thing. If earnings per share is going down, then of course shareholders are losing out. All right? It's very common to be asked to work out earnings per share, very common. But there's very little comment required. I think it stands to reason. Shareholders want earnings per share to increase. They're going to be worried, certainly, if it falls. Okay? Finally, one of the most important of all, he doesn't always ask this one. As I say, he picks 3 or 4. But very often, and in some ways the most important of all of them, the PE ratio. Awfully important, partly because it's printed in newspapers. When they print share prices and everything, they print the PE ratio as well. Arithmetically, it's easy. The PE ratio is the market value per share divided by the earnings per share. And so before we say anything at all, check the numbers. You only do this on ordinary shares. The market value of the ordinary shares at the top of page 78 is 83 cents. The earnings per share we've just calculated, sorry, I'll write it in cents otherwise I'll get lost. It's 83 cents. The earnings per share we've just calculated is 5.2. And so the PE ratio, is this correct please? 15.96. Now on pure numbers, is everybody happy? Please? Alright, well I say this is not always there, but it is the most important of all of them for the exam. The number's easy, I mean obviously just learn it. It's PE ratio, it stands for price earnings ratio. The price, the market value, divided by earnings per share. So he might say price earnings ratio, but normally he says PE ratio. Here though, when it's asked, he will definitely want a proper comment. He does expect you to know what that means and why it's so important. Before I write down, don't write this bit down, but if I told you our company, this company, has a PE ratio of 15.96. I then said, here's another company, and don't write this, but other company has a PE ratio of, let's say, 10. Can anyone tell me what it means if we've got a higher P ratio? So you're talking at once, I couldn't hear. Sorry? Alright, numbers wise I suppose you're right. Sorry?
It means we'll overpay.
Means we overpay? Oh, I'm not sure I agree now. You can phrase it in several ways. The way he's phrased it is this. I'm going to write two lines. First of all, sorry, I'm not going to keep writing 15.96. Let's call it 16. Would you agree this? On a P ratio of 16, it will take 16 years for the investor to get back the investment based on current earnings. Would you agree with that statement? I don't think you can disagree. If the earnings are 5.2 cents a year, it will take 16 years to get back your 83 cents. Now, we've not finished yet, but would you agree that statement? Fine. So I'm saying if you buy this share, it'll take you 16 years to get back the money. Suppose I offer you another share, a completely different company. Their share price is $2, and they're paying earnings of 10 cents a share. Well, obviously, if it's got higher earnings, you expect to pay more for the share, you would agree? That's not a problem. The more the earnings, the more you'll pay, clearly. But this one would have a PE ratio of 20. Why on earth would anybody buy the second one? It's going to take them 20 years to get the money back. Whereas our company, it'll only take them 16 years. And yet you do have some companies with P's of 16 and other companies with P's of 20. Why on earth would anybody buy the second share? It'll be 20 years to get the money back. Ours gets the money back in 16.
We have no guarantee that it will.
You don't get anything. I think I know what you're getting at, but don't use those words. Nothing's ever guaranteed. Let me be more extreme. You know Amazon? Amazon?
Yeah.
Buying books and things. They used to have a P ratio. This is really extreme, but their P ratio, not that many years ago, was something like 3,000. Which meant it would have taken 3,000 years for people to get their money back. Why on earth did anybody buy shares in Amazon? Let me tell you. That statement is physically true. Back to ours. It will take 16 years to get back based on current earnings. But surely, normally, usually, when you invest in a company, you are expecting the earnings to grow. Would you agree? Would you also agree, does this make sense, that the more you expect the company will grow in the future, the more you'll pay for the share? Surely, if you're buying shares in my company, however well or badly I've done in the past, if you thought I was going to make huge profits in the future, you'd pay a lot for the share. If you thought I was going to do really badly in the future, it doesn't matter how well or badly I've done in the past, if you think I'm going to do badly in the future, you pay a very low price. Would you agree? But the better you think I'll do in the future, the more you'll pay for the share. True? Tell me again. Or tell me one step in between. The more you pay for the share, what will happen to the PE ratio? It'll be higher. You know, current earnings may be 5.2 cents. But the price you'll pay for the share will depend on how good you think they'll do in the future. The better you think they'll do in the future, the more you'll pay. The moment they're paying 83. If they suddenly thought, oh, this company's going to really rocket in the future, maybe they'd be prepared to pay, 120 for the share. You know, the better they think it'll do, the more they'll pay. But automatically, the more they pay for the share, prepared to pay, the higher the PE will be. All right? People who bought shares in Amazon when the PE was 3,000, they weren't expecting it to take 3,000 years to get the money back. Of course they weren't. They were prepared to pay a lot because they were expecting the earnings would grow very quickly. The more growth they expected, the more they'd pay, but therefore automatically the higher the PE. Do you all see what I'm getting at? You must learn, but you must also be able to explain properly, not just one line, that higher PE suggests that shareholders are expecting higher future growth. I but suggest, you know, stock exchange doesn't work perfectly. There can be all sorts of problems. It's also based on what they expect. Just because you expect there'll be high growth doesn't mean there will be. You would agree? You would agree? But the price you pay depends on how much you expect them to grow in the future. The more you expect it to grow, the higher the price you'll pay, the higher the PE. Higher PE means you're expecting higher future growth. All right? Are we clear?